Welcome back to the channel, guys. In today's video, we're going to continue talking about stocks, and I'm currently in the process of building a 30 stock diversified portfolio. In a video I made last week, I talked about 10 stocks that are on sale that I recommend buying now. These are stocks that I have personally already bought. In today's video, we're going to talk about 10 more stocks. The reason why is because I got my stimulus check, $1,200 from the federal government, and if this is your scenario where your job is secure, your finances are secure, you're taken care of, and you are investing anyways, then getting $1,200 and buying stocks with it is kind of what the federal government wants you to do. They're trying to prop up the stock market. So by sending a stimulus check to everyone, yes, for people who have been adversely affected by what's going on, definitely pay your bills, meet your needs. But if you are already investing, this is just $1,200 more to invest. So in this video, I've done quite a bit of research. Honestly, I've gone through like 200 companies looking at all of their information, and I've narrowed it down to 10 stocks for you that you can buy for exactly $1,200. So if you like this video, give it a thumbs up. As always, before we go any further, I am not a CPA, I am not a financial advisor. This video is for entertainment purposes only, not financial advice. Do your own research. Okay, now in the back of your mind, you should always have the question, should I be picking individual stocks? If you don't think that you can outperform the market average, if you had just invested in a low-cost S&P 500 index fund, if you were not going to beat the long-term average of 9.8%, then maybe you shouldn't be picking individual stocks. I'm personally having this question, so whenever I research a stock, I say, would I have been better off just investing in an index fund? Can I beat the long-term market average of 9.8%? And, index funds are peculiar because they don't operate on any thought or emotion. They have an algorithm deciding everything, and for a total market or an S&P 500 index fund, it just says buy everything, an equal amount at a proportionate share of whatever their market size is. So it picks all the winners, in the past, Apple, Visa, Amazon, Microsoft, and it picks all of the losers, GE, Sears, stocks that don't really do anything like Twitter and Snapchat. So what if I can build a stock portfolio of 30 companies that historically have outperformed the S&P 500? I can't predict the future. Will all of them continue to beat the market average? Certainly not. But will more than half of them? That's what I'm trying to do. My simple criteria when picking stocks is, has the stock price, its capital growth, doubled in the last 5 years? If it has, I know it's beaten the S&P 500. I'm also not trying to, double my money in 3 months. Like, I'm not trying to choose stocks that will just out of nowhere balloon up. So I'm making conscious investments, and I'd like to hold these stocks ideally for 3 to 5 or maybe even longer years. So I'm not trying to pay short-term capital gains on anything that I buy today. I'm also looking for stocks that pay any kind of a dividend, even if it's just 0.5%. My opinion is once a company starts paying dividends, it changes its behavior almost. If it's a pure growth stock, then it's much more prone to wild up and down swings. So once a company starts paying a dividend, the share price becomes more stable. I'm also looking for well-established companies, ideally with at least 10 years worth of market history in order to observe. I'm also ideally would like to know, how did this company perform after the 2001 recession, the 2008 recession? I'm not looking to invest in any companies that might go bankrupt, so that excludes the airlines, the cruise lines, the hotel chains. And I'm currently looking for stocks that are at a discount. There are great stocks that I would love to invest in, like Costco, but when you look at their share price, they're not down. There is no recession for them. Costco is still open and they're getting more business than ever. Same with Clorox. Clorox is a great company, but everybody's buying their products like mad, so their share price is through the roof. Okay, let's get started. And the first stock that I am buying is Estee Lauder. And this is a makeup and fragrance company based out of Manhattan. It's one of the largest in the world. And my thoughts is people are not going to stop buying makeup. I think this is a company that has proven to be profitable. And I don't see people in the future, men and women, stop wearing cologne, stop wearing makeup and perfume. What's happening here on the left is I'm including all of the ratings that Schwab provides me. I have a Charles Schwab brokerage account, and I've taken screenshots of what basically all the rating agencies are saying about this company. And Schwab is currently rating them a B. Now, I should clarify with these ratings is Schwab's equity rating is based on how will this company perform in the next 12 months compared to their peers in their sector. Now, I don't necessarily care about the next 12 months. I think personally every company is going to be doing on the books worse because of what's going on in the world. So Schwab's rating and all these other rating agencies like Morningstar, I'm looking at it and I'm interested, but once again, I'm making long-term investments. I'd like to hold all of these stocks ideally longer than 3 years. So their ratings, they're great, but it's more of just a guideline compared to what I'm personally looking for. When you look at Estee Lauder's capital growth, it was up 166% in the last 5 years, pays a 1.19 dividend, and it currently is 26% down from its 52-week high. So if you want a great company that's currently 26% off, I recommend Estee Lauder. The next stock I'm investing in is TransUnion, and TransUnion is one of the 3 credit rating agencies in the United States, the other 2 being Experian and Equifax. Now, TransUnion is the smallest of the 3. However, I feel like with the Equifax data breach, they've been losing a lot of business, and TransUnion has been gaining that business. However, this is a global company that aggregates information on over 1 billion consumers around the world. They operate in every country that needs credit rating services, so they work with over 65,000 businesses. Their Schwab credit rating is a B, and Morningstar is giving them 3 stars. The downside of this is that it's actually, because it's such a new company, their IPO was in 2015, so we don't have a lot of information about them. However, their share price the last 5 years was up 307%. They do pay a small dividend, currently only 0.42%, and they're currently 30% down from their 52-week high. So I view this stock as a discount. Next stock is Cincinnati Financial Corporation, and this offers property and causality insurance. It says it's the 20th largest insurance company by market share, so I guess there's 19 companies that are larger, but this is one of those dividend aristocrat stocks that have consistently grown their dividend payouts every year for at least the last 25 years. But this is an incredibly run, well-managed company. All of the rating agencies love it, and when you look at their stock growth, beside offering a huge 2.91% dividend payout, their stock appreciated 125% in less than 5 years. So it was beating the S&P 500 by far. And it's currently 30% down. I feel like this is one of those stocks that is currently undervalued. The P to E ratio is only 6.82. And there's really no bad news saying why we shouldn't expect this company to rebound and then be profitable in the future. Next company is Weston, and you've probably never heard of it, but it is an American food processing company and one of the world's largest producers and processors of frozen French fries and other potato products. It's headquartered out of Idaho, and once again, the ratings are pretty decent. Schwab gives it a C, Morningstar gives it 3 stars. Yes, I think with all of the restaurants being shut down, they're not pushing as many potatoes, but honestly, they got the potato monopoly in the S&P 500, and I don't think people will ever stop ordering waffle fries. So eventually, the food service industry will recover, will come back, and this company will continue pumping out potatoes. But in the meantime, just plant fewer potatoes, I guess. I think this company will do fine in the future. Its IPO was only in 2016, so it's relatively new, but it was up 187% in the last 5 years. It pays a 1.6% dividend payout, and it's currently 40% off. Next up, we have the Intercontinental Exchange, and I'm not going to lie, they have the coolest stock ticker symbol of ICE, I-C-E. And the Intercontinental Exchange actually owns and operates the 12 regulated exchange and marketplaces. So they're the ones who own and operate the New York Stock Exchange, where everybody trades all their stocks. And they've got exchanges in London, Chicago, Amsterdam, Calgary, Tel Aviv, Singapore. And their ratings are decent, C, 3 stars. When you look at their evaluations, they have positives and negatives, but their stock performance has been pretty good, up 128% in the last 5 years, pays a 1.36% dividend payout, and they're not down that much from their 52-week high, only 13%. But I feel like this is a company that knows stocks, and I think that going forward in the future, they're going to remain profitable, and I don't see the New York Stock Exchange ever closing down or losing money. Next up is Arthur J. Gallagher and Company, and this is a US-based global insurance broker and risk management services. It's headquartered out of Illinois, and it's one of the largest insurance brokers in the world. Currently, they're getting good ratings, at least a C from Schwab. Credit Suisse says outperform. They're going to remain profitable in the short term, and I like what they've been doing in the past. Their stock price has been up 130% the last 5 years, pays a really high dividend payout of 2.23%, and it's currently 26% down from its 52-week high. You can also see how the stock price performed after the 2000 and the 2008 collapse. This company did fine long term. Next up is Intuit, and I think everybody knows this company. Intuit owns TurboTax. They also own QuickBooks and Mint. They recently bought Credit Karma. I don't think people are going to stop doing their taxes or downloading software to manage their finances. All the credit rating agencies think that this is a good buy. They're going to remain profitable even in the short term. Death and taxes, the only two certainties in life. And when you look at their stock price, up 221% the last 5 years, pays a small dividend to 0.82%, and it's currently still 16% down from its 52-week high. Next up is the Automatic Data Processing Company, and this is a provider of human resources management software and services. For the longest time, this was only one of a few companies in the S&P 500 that had a AAA credit rating from both Standard & Poor's and Moody's. It's an incredibly well-run company. Currently, they're going to take a hit in the short term. Their profitability is not looking great for the next couple quarters with all the businesses shut down. But when you look at what their share price has done in the past, last 5 years, they were up 118%, dividend payout of 2.66%. I don't think they're going to cut that. They're currently 24.9% down from their 52-week high, and you can see how they did after the 2000 collapse and the 2008 collapse. This stock has performed very well. Next up is the Dover Corporation, and this is kind of a conglomerate manufacturer of industrial products. They own 3 segments of engineering systems, fluids, and refrigeration and food equipment. It is actually the highest rating. Schwab Equity is giving this company an A, and Morningstar is giving it 4 stars. So this is probably the best performing stock that I'm showing you on my list. Profitability is positive. They don't have any red on their balance sheet. This is also one of those dividend aristocrats, meaning that it's grown its dividend payout for the last 25 years consistently. When you look at how their stock has performed the last 5 years, up 104%, in addition to paying a 2.33% dividend payout, and it's currently still 30% off from its 52-week high. And then last we have Microsoft. I don't see how anyone can get around this company. Microsoft and Apple are always going back and forth right now between being the largest company in America. Everybody knows Microsoft. People are not going to stop using Windows. People are not going to stop using PowerPoint and Excel. People are not going to stop playing Xbox. Their Schwab rating is a B. Morningstar gives them 3. When you look at what their share price has done the last 5 years, it's insane. They're up 358%. They pay a small 1.15 dividend payout, and it's not much of a discount anymore because it's rebounded so fast, but it's still 7% down from its 52-week high. And there you have it, guys. Those are the 10 stocks that I recommend to buy. If you buy one of each at their current share price as of filming this video, you would pay $1,197.03. That would leave over $2.97, enough to go get a McFlurry from McDonald's. And you can enjoy your McFlurry while your stocks appreciate in value over the next couple years. Okay guys, if you enjoyed this video, give it a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I talk about finance and investing topics. And if you have any questions or comments, leave me one down below. Also, what stock picks did I miss? Leave me your stock picks down below, and I'd love to give you my thoughts on it or hear your thoughts on it. And until the next video, take care.